Hey everyone, I'm excited to share with all of you today 5 dividend stocks that are top of my list right now. Actually, I have 2 bonus stocks that I'm going to share. These are 7 stocks that I am incredibly focused on right now. We're in the middle of a correction. We're in the middle of a bear market, if you will. So my strategy is going back to basics, if you will. I get this question all the time here on YouTube. Ian, if you were starting over, how would you hypothetically invest $10,000? Well, I want to share the 5 stocks today that I would purchase $2,000 increments each if I were hypothetically starting over. I like going through this exercise because it gets me back on focus and it helps set my own strategic themes as an investor as I look forward. In addition to these 7 stocks today, I also want to share with you all 10 rules or 10 themes that I'm personally living by right now as an investor in the middle of these turbulent times. Get ready, everyone. I have a really exciting video in store for all of you today. Welcome to PPC Ian. This is Dividend Stock Investing for everyone. All right, everyone. So as I prepare for these videos here on YouTube, I always like to have a hip hop song going in the background that serves as kind of a theme or a focus for me for that particular video. And for the video today, I was listening to an old school track called Who Got the Props by Black Moon. Now, the reason I was listening to this particular track is because I do have the props today. Who got the props? I got the props. I'm going to be sharing some props in the video today about my favorite dividend stocks. And so I've got this Scotch blue tape here from 3M. We're in our new home here in Idaho, and I've been spending a lot of time hanging up photos on the wall, doing things around the house. This tape comes in so handy every single day. And so I always have that in full stock. And of course, one of the top 5 stocks I want to share today is 3M. And so here's what I'm going to do. I'm just going to share it on the screen right now. As you can see in front of you right now, there are 5 stocks on the top. There are 2 stocks on the bottom. The reason I have the 5 stocks on top is that's how I would hypothetically right now, if I were starting over, invest $10,000. I would do $2,000 into each of these 5 stocks. But I have 2 bonus stocks on the bottom. These are alternatives. And so instead of McDonald's, I could add Starbucks as an alternative. Instead of 3M, I could add HONEYWELL as an alternative. And so that's where the 7 stocks go about. Now, before I get into all of the details behind all of these stocks, I want to share something big. I actually sold a stock in my portfolio today. I rarely do this. And so I'm going to share on Patreon, by the way. Check out the pinned comment below if you're not already on Patreon. I'm going to share these trades on Patreon later tonight. I actually sold a stock today. I took the proceeds. I added to one of my other positions. And the position I added to is one of the 7 positions on the screen that I just shared. And so put a guess in the comments below which one I purchased. But I'm going to share all of that over on Patreon. I've got a lot of bonus content over there, so make sure to check out the link in the pinned comment below. But without further ado, as you can see on the screen in front of you right now, I want to briefly go through these positions and why they are so important to my strategic theme right now as going back to basics as a dividend stock investor. So stock number 1 is Johnson & Johnson. I have talked about this stock at length. I sound like a broken record here. I don't have a prop for Johnson & Johnson right now. But the thing I like the most about this particular position right now is it's trading at a forward PE in 2023 of a 16. I feel that because of some of the legal risks that they face, it's trading, even though it's been trending up in price, it's been trading at a reasonably low PE given the overall context of the broader market. I love that their starting yield is 2.54%, so it's not huge, but the fact of the matter is they're growing that on average by 6%, 6.1% per year, and as I highlight the payout ratio, it is so low. The amount of earnings that they are paying back to shareholders in the form of dividends is only 44% of 2022 expected earnings, and so there's a lot of room to grow that dividend. This stock is a machine. It is $467 billion. And what I like about Johnson & Johnson so much, quite frankly, is that it is 3 in 1. It is one stock, but I get their consumer division. It is one stock, but I get their pharmaceutical division. It is one stock, but I also get their medical devices division. And so hypothetically, if I were starting over again with 10,000, it's nice to get broad diversification right off the bat, even with this single position. Now, my portfolio is a larger portfolio, but I still take so much comfort in the fact that this is diversified. Now, it is going to split into 2 companies at some point. They're going to spin off the consumer division from the pharma and medical devices division, and so it will become 2 companies. But I just keep adding more money to this stock because I want to add as much as possible before it splits into 2 companies, because I believe the valuations here are attractive. And so that's the first stock. I talk about it all the time. It can get boring, but I'm underscoring that. Boring is good. Boring is very good during times like this when the market is so turbulent. With that, I want to get into my next position. Unfortunately, I don't have any props for this one. I had a bunch of these bubbly sparkling waters, but I drank them all. As you can see on the screen in front of you right now, though, next position is PepsiCo. And Pepsi, I didn't highlight anything about it, anything at all. Maybe, honestly, I'm doing this in real time here. I'm going to highlight the sell for dividend yield at 2.76%. It has a reasonably good starting dividend yield, and it has a high compound annual growth rate on that dividend of a 7.4. So I guess that's a good thing as well. But the PE ratio is a little bit higher on this particular stock. PepsiCo, for me, is a flight to quality. This is a flight to quality during tumultuous times. I'm going to speak more about this at length later in the video, but there's a lot going on right now. There is a lot going on in our world. There is a lot of geopolitical risk. There is a lot of inflationary risk. There is a lot of instability right now, and it's concerning to me as an investor. And so I learned a lot, though. I live in Idaho now. I used to live in the San Francisco Bay Area. In the San Francisco Bay Area, there are a lot of folks that live there who have come from China. And these are the wealthy elite, the smartest of the smartest coming from China. A lot of them work in engineering jobs in the San Francisco Bay Area. And I learned a thing or two from all of my friends. And what I learned was a lot of these Chinese residents in the Bay Area, they bring a lot of money over from China. They also are earning a lot of money because they're high earners here in the United States. But what happens is they take their money and they buy up real estate. And they're buying up real estate, they're buying up condominiums. Some of them are not even living in the real estate that they buy because they're buying more than one residence. They're buying a lot of real estate. And why are they doing that? It's a flight to quality. They know that that real estate in that greater metropolitan area, yes, California has its issues. Yes, the greater Bay Area has its issues. These days, a lot of places have issues, but they know in general that the money is safe in that real estate in the Bay Area. It is, if you will, the gold standard of real estate. Over long periods of time, over decades of time, that real estate will have value. I've been looking at my dividend portfolio that way lately. It's a flight to quality, and even with an overall portfolio that's a very high quality, I'm trying to upgrade my quality even more because of what's happening in our world. And these days, my strategy is all about cash flow. I already use dividends to pay the bills, and increasingly so, I want to be able to cover all of my bills with dividends, but I am willing to delay that goal a little bit in an effort to have quality, because the last thing I need is a house of cards. The last thing I need is a portfolio where the dividends could get cut. The last thing I need is instability in the portfolio. And so for me, it is a flight to quality. I'm sure the Chinese investors coming into the San Francisco Bay Area, buying up all that real estate, they understand that it's not cash flowing because a lot of those condominiums have HOAs. They understand that they might be buying the peak of the market and the real estate market could collapse, but they know that that real estate has intrinsic value. They know that that real estate is the gold standard of real estate. They know that that real estate will weather storms over time as long as they don't take on unnecessary leverage to purchase that real estate. And just in the same light, that's how I look at stocks like PepsiCo. They can shoulder the risk and get my portfolio through almost anything. With that, I want to go to the next stock, but I'll tell you, I've done healthcare so far. PepsiCo, that is a food company, consumer packaged goods with a food emphasis, but you not only get soda, you also get snacks, you get the Frito-Lay division. They have a lot going on there, so it's a broadly diversified food company. Snack foods too, and snack foods are really popular these days for many reasons, but I can just give you my own reason. I oftentimes don't even have time to eat a lunch, and so I'll just snack on something. Go PepsiCo. With all of that, I want to get into the third stock. Don't worry, I do have the props. They just come in a little bit later in the video. As you can see in front of you right now, the next company is McDonald's. Now, what I want to share about McDonald's that I love so much is the 5-year dividend compound annual growth rate. It's 8%. They're increasing the dividend by 8% on average per year. Again, I'm not going to have so much cash flow overnight buying this stock at a 2.24% starting yield, but it is a flight to quality. The dividend is growing, and my long-term yield on cost after holding this stock for many decades is going to be massive. Now, why I like McDonald's is it adds not only real estate, but also a restaurant to the portfolio, and they're carrying their real estate on their balance sheet just as a matter of fact. It's so interesting. They're carrying it at cost, so I think they undervalue their real estate on their balance sheet, but I digress. But that's why I love McDonald's. I think they could split the company into a real estate company and a restaurant company. They could have two separate companies. They are one of the biggest landlords there is. They've franchised out most of their restaurants. They found that their franchisees can manage the restaurants better than they can in-house, but they collect rent and they own the real estate. Now, what I wanted to do, though, is provide an alternative to McDonald's here. McDonald's is a little slower growth right now. McDonald's is a little bit more expensive right now, given their growth. Why is it expensive? It's expensive for the same reason that San Francisco real estate was expensive. It is a flight to quality. Many investors take comfort in having a stock like that. But for investors who might want an alternative, they might want a little more growth, they might want to take on a little more risk, I would say, here's the props, Starbucks. Now, this is the Frappuccino. Usually I drink this at Starbucks. I have it made to order. I was there just earlier today, but certain times I can't do it. I'll tell you, tomorrow morning I'm presenting on the Investing Academy by Brandon Beavis. I'm doing a guest presentation over there. I'm not going to have time to get to Starbucks, come home, do my presentation, so I'm going to be drinking one of these in the morning. But I got more props. I got these kind of Starbucks things all over the house, all over my office, because Starbucks now is my number 2 position in my portfolio, surprisingly enough. And the reason I'm listing it here as an alternative, and the reason it's my number 2 position, is because it is growing so quickly. They're facing some challenges, and so it's priced at somewhat of a discount given the expected growth in the future. And so if I were constructing a new portfolio from scratch, I could see myself potentially substituting Starbucks instead of McDonald's. But I'll tell you, with Starbucks, the downside is it's not a lot of real estate exposure. It's mainly the restaurant exposure. But the upside, I would say, is it gives me, the investor, a little bit more exposure to growth. Now, what I like about Starbucks and McDonald's is they both have a lot of exposure towards technology. Boy, those companies are firing on all cylinders as it pertains to technology. But as you can see in front of you on the screen right now, what you can see about Starbucks is the 5-year dividend growth rate on average is 14.4% per year. Now, we shall see if that holds up. I don't know. With some of the union challenges that they're facing. It is increasing costs of running their business, and temporarily they may need to slow down that dividend growth rate. I hope they don't, but they paused their share repurchases to my understanding. Now with Starbucks, as you can see, it's a mid 2% starting yield, and PE is a little bit higher, even though the stock has come down, but the PE is a reflection of the challenges they're facing now. Once they get through some of the current challenges, such as the lockdowns that come and go in China, and also the union costs that they're facing in the United States, those PEs should come down, in my humble opinion. And so Starbucks has actually surpassed McDonald's in my personal dividend stock portfolio. I did a whole video on this. I will link to it in the pinned comment below. I would not be surprised at all if Starbucks surpasses J&J as my number one largest position as it recovers. It's just a function of math. Now, with all of that, I want to get into the next stock today. I want to get into the defense sector. You can see right now that I'm going through different industries, and it's important to me as I construct a portfolio. Hypothetically, I'm starting over, but even as I construct a portfolio I already have, it's really big, but I'm adding to all types of different sectors because I never know which one is going to do well. Who would have thought the energy sector right now would be performing so well when in the depths of the pandemic, these companies were in so much trouble with the price of oil basically at zero? Who would have thought? Also, who would have thought that General Mills, despite all of the inflationary pressures we're facing right now, is hitting the ball out of the park? As you can see on the screen right now, I saw this news yesterday. I own General Mills. It's not on the stock list today, but boy, this just shocked me that they reported their fourth quarter and full year for fiscal 2022, and they just hit the ball out of the park. And you can see the subheading there is General Mills Board of Directors declares 6% dividend increase. I love that they put that front and center. It shows me that they care about the dividend, they care about the shareholders, and I don't need to read the numbers now, but what I want to say is the numbers are great. The stock price is reflecting the numbers. It's up and to the right. I would have never expected this because this is the type of company that could get hit so hard by inflationary pressures. But despite the inflationary pressures, they surprised me. They surprised me. I would have never thought that they would do so well. And that's just why I like to pick the best of the best in all the categories. But at any given time, I don't know which category is going to outperform the other. And even within a category like CPG food, General Mills has peers that are doing poorly. And so it's so interesting to see that they are doing really well right now. Way to go, General Mills. But anyway, with that, I want to get into the defense sector. As you can see in front of you right now, this is a stock I've been adding to pretty heavily. My patrons already know this. I've been adding to RAYTHEON Technologies. I love RAYTHEON because the 2023 forward PE is 16. And with all the geopolitical challenges the world is facing right now, I do believe that RAYTHEON provides the technologies and the products to add to defense. And I think defense is really important in light of all of the challenges our world faces. I always hope for peace. And I honestly think a great defense can lead to peace because no one is going to mess with a country that has a strong defense. Defense is the best offense. And so same goes for dividend stock investing. Quite frankly, having a defensive portfolio is so comforting in times like this. Again, the PE ratio, love that, 16s for next year. And what I would also say about RAYTHEON is over the last 2 years, they've been growing the dividend on average by 7.6% per year, and payout ratio is low, so I think they'll keep that up. And my patrons already know this, but I've been adding to RAYTHEON in a heavy way over the last few months. Now, with that, I have another stock I want to share with all of you today. You already saw the prop for that one, but I'll get it again. It's the painter's tape. It's 3M. And so with 3M, what I want to say is they do have some risks right now, obviously, with some of the legal risks they're facing. That's why the PE ratio is so low. So as you can see in front of you right now, with 3M, they have a huge starting yield of 4.62%, payout ratio 55%, but the PE ratio, boy, it's in the 11s now. I highlight it. Why is it in the 11s? This stock is priced very low because of legal risks. And I've spoken about that a bit in some of my past videos. And so I love 3M. It's one of the largest positions in my portfolio now. My patrons already know this. If you head on over to my corner Patreon on the corner tier, I share the percentage allocation to all the positions in my portfolio. And I'm going to need to update that portfolio soon because I did sell a position today. With all of that, I want to share an alternative to 3M, the lower risk alternative, if you will, and that is Honeywell. And so here you go. I have these all over the house. This is the Honeywell branded air purifier, air filters. Good to keep the great air quality. And we all know that with smoke and wildfires, all of that kind of stuff, it's important these days to have an air purifier on standby in the house. And so I always go with the Honeywell brand. But as you can see in front of you today on the screen, I love Honeywell here at a price per share of 173. It's hitting new lows almost every day. That PE ratio for 2023 is down to a 17, which I think is fabulous for Honeywell. They've been growing the dividend on average over the last 5 years by 8.1% per year. And again, starting yield in the mid to low 2% range. You've seen throughout the presentation, I highlight certain numbers. Out of all of these stocks, the ones I would say where I see some level of value is J&J. It's RAYTHEON, it's 3M, it's Honeywell, maybe a little in StarBucks as well. And so I see some value in those. I would say that with McDonald's, PepSico, those are a little more expensive. I'm not seeing as much value there. And you could argue the value probably at Starbucks. But again, those are the stocks. And so you saw the 5 stocks on the top line and then the 2 alternatives. And I had to throw in General Mills there for fun as well because they surprised me. If you enjoy the video so far, please go ahead and smash the like button. It means the world to me. It helps this video reach more people. It helps my channel grow. And I put so much effort into these videos. It means the world. So thank you for doing that. Don't forget to click the subscribe button as well with the notification bell. I do have videos on the way all the time. Now, with all of that, I have a second segment of the video today. I want to go through 10 kind of golden rules that I'm living by right now as an investor because I've learned a lot. I'm over 20 years into my investing career. I have been dividend focused for the majority of my investing career. But what I would say is I'm always learning, and this market is humbling. And the older I get, the more I realize, the more I have to learn. And that's what's fun about life. That's what's fun about investing. And so I want to share how my strategy is changing just a little bit, not much, but it's going to be a little bit more boring, but that's okay. So as you can see in front of you on the screen right now, these are the 10 themes that are going through my mind that I'm living by in June of 2022. Cash is not trash, everyone. You hear that all the time, but the cash is losing value. The cash is eroding in value. I would say that asset protection is paramount. And so I would rather hold cash than take on undue risk or make a suboptimal purchase. And so I just want to put that out there that I have respect for cash and I don't think it's trash. And I'm not going to rush into a stock, especially a risky stock with the hopes of quote unquote beating inflation. So many investors right now, they're taking on undue risk in an attempt to beat inflation. Quite frankly, I think that's one of the worst things that an investor can do, but I can only focus on my own portfolio and my own strategy. That's why I do not think cash is trash, even though it may be losing some value to inflation. Let's keep going. As you can see in front of you right now, the next rule I'm living by is basically I've realized over the last few years, I've taken on some risk. I document my journey here on YouTube for all of you to see it. And so it's easy to do that in a bull market. I'm getting back to basics. I think a bear market is a great reminder to stay focused. And I have been through these cycles enough times now where quite frankly, I want to just remember the turbulent days we're going through now. And my go forward strategy is essentially set in stone for all of eternity. I'm putting this live on YouTube so that I can hold myself accountable. But barring any major shift in geopolitics that just takes out the stock market as we know it, going forward, I'm just focused on core dividend stocks. The ones like the stocks I mentioned today. Yes, I have a few ancillary positions here and there. Yes, I have a few speculative bets that I'm making here or there in other spaces like cryptocurrency. But the amount of money I'm putting into those types of investments is such a small percentage, and it will be such a small percentage going forward that really, for me going forward, this most recent downturn has just reminded me, Ian, stay on course, stay boring. Boring is a good thing. And so that was a big lesson for me, as I can share on the screen in front of you right now. The next one I want to share is The short list of stocks I'm buying right now is very short. There's some others on the list that I did not share today, but it's a short list. I'm aiming for stocks right now with starting dividend yields in that mid 2% range because that is sustainable, payout ratios that are sustainable, and I'm trying to get a 7% expected compound annual growth rate on the dividend. I sold a position today. Why did I do it? It just wasn't quality. I bought it during the bull market. I got a little distracted. It wasn't quality. It's not the right thing for me. I'm focused on quality above all else. I instantly redeployed that into one of the stocks mentioned today. Rule number 6, I learned a lot from the Chinese investors buying U.S. real estate. I'm focused on quality assets, a flight to quality. I know the asset values over time may go up, they may go down, but I know that quality is always quality. And so slow and steady with a focus on quality over all else. I'll tell you, I'm going pretty heavy right now, and I have been going heavy. I've been making a lot of trades. I've been making a lot of purchases because I see some value. I think this bear market could last. I think it'll get worse. I think the Fed sometimes is the market, and if the Federal Reserve keeps increasing the Fed funds rate, the market will keep going down. And as it does, I'm going to buy heavy. I'm going to keep buying heavy. But I will tell you, when this market recovers, and it eventually will, I want to take a Warren Buffett style approach. And I'm going to keep buying stocks because I always do, but I'm going to go pretty cash heavy at that point. And I'm just going to wait. I'm going to be patient. I'm going to wait for the next crash. But for me right now, I'm all in buying all the way down. And I do think it's going to head lower. I don't know when the bottom will be. I cannot time the market, but I think that will happen, that the market will probably head lower. All right, check it out in front of you right now. The next rule that I'm living by right now is I need to remember to stay somewhat diversified. Winners are unexpected at times. I did not expect General Mills to be a winner, but I'm sure, and there's nothing wrong with the company. I'm just saying in these times of inflation, I didn't expect that it would pull through so well. And so that's why it's important to be diversified. Heck, my energy companies have helped me out so much recently. Who would have thought? I'm grateful to have them. I'm not adding to energy, but I'm grateful to have them. And what I would also say, and this is important in terms of thought number 10, I hate to leave it on kind of a negative note, but I am seeing a society that is evolving. Especially here in the United States. I have a lot of European subscribers. By the way, shout out, I love all of my European subscribers. Please put a comment below if you're from Europe. Thank you for tuning in. I hope to visit you all one of these days soon. We're planning a European vacation some point in the future. Boy, that'll be amazing. But you see this in Europe, you're seeing it in the US. There's this sense of entitlements in some ways. The government is promising certain things to certain people, to lots of people, and unfortunately someone has to pay for those entitlements. Someone has to pay for those government promises, and ultimately it's going to be the taxpayers. And so I'm starting to realize that taxes probably have nowhere to go but up, and so I need to be careful to build cash flow that can pay for taxes. I need to save money that can pay for taxes. I need to be careful not to inflate the lifestyle too much, but to be mindful that the tax rates may go up over time. There may be new kinds of taxes. Boy, I don't live in California anymore, and I got nothing but love for all of my friends in California, but I saw something today that Governor Gavin Newsom was saying, hey, we're going to send out more stimulus checks because of inflation. He's promising to folks in California that because inflation is increasing the cost of living, the government's just going to send you a check. Well, in theory, that sounds good, but the problem is you can't fight inflation with more inflation. So sending out all those checks, one, it's going to cause probably more inflation, but two, someone has to pay for those checks, and ultimately it's going to be the taxpayers. And so I see that as part of my strategy going forward as well. And so if I take a step back, I have a worldview where I want to protect assets in a flight to quality. I want to build sustainable cash flow in those core dividend stocks without taking on undue risk. And I just want to be mindful where our world is going. And I am not super optimistic about where things are going from a political standpoint and a broader geopolitical standpoint, but I also know that I can't foretell the future. And just when things look pretty nasty out there, usually they turn for the better. And so that's just how our world is. And so I think we don't know what's next, but I bet you it's something good, because humankind has always marched on and gone on to bigger and better things. And so let's hope for the best there. All I can do is stay focused on what I can control, and that's my dividend stock portfolio. And so let me know, everyone, in the comments below what you think about my 10 thoughts that are going through my mind now, what you think about my hypothetical $10,000 portfolio. And it's not only that, it's hypothetical if I were starting over, but it's the real deal for me right now, because those are the very stocks I'm adding to right now. Those are the stocks I'm really focused on. And if you enjoyed the video, please go ahead and smash the like button. It means the world to me. It helps the video reach more people. Please don't forget to subscribe as well. Before I go today, in terms of a full disclosure, I am long the stocks mentioned today. I am long General Mills, ticker GIS, Johnson & Johnson, ticker J&J, PEPSICO, ticker PEP, McDonald's, MCD. I am long Starbucks, SBUX. I am long 3M, MMM, Honeywell, HON, and can't forget it, RAYTHEON Technologies, ticker RTX. I'm long all of those stocks in my personal dividend stock portfolio. Before I go today, it is important to mention, in terms of a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. I share my personal journey here on YouTube for fun and entertainment only. I love you all. I'm going to see you in the comments below. Thank you for tuning in today, and I will see you in the next dividend stock investing video.